Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will check out market reaction to the Bank of Canada boosting interest rates. Danielle Park, editor of the popular blog Juggling Dynamite, says with interest rate hikes likely to continue, it's time for consumers to trim costs, downsize, and look at their financial future with a critical eye. Gold and silver activist Ed Steer comments on what he feels is a totally manipulated precious metals market. However, he says he'll continue to do his best to change that. Plus, at the end of the show, we'll have company showcase updates with American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to the show, Ross.
Nice to be back with you, Jim.
Boy, all the headlines, of course, in the financial world in Canada about the interest rate hike by the Bank of Canada. How did the markets react to that, or did they react at all?
Well, they reacted stronger than I think most of us were looking for. I mean, clearly this was a telegraphed rate hike, has been 6 or 8 weeks in advance. But the quarter point came as, I think, what it was, a 90 or 92% of the analysts had estimated that we would get that increase. So it's with us. But, Polos is saying, and others there at the Bank of Canada, that the economy is strong enough that he can foresee future advances before this year is over. And at this point, if you exclude the consumer price data that they like to use, clearly the dollar has liked what they've come through with. Now, but we've tacked on about 6% now on the month, which is just a huge move for any currency. When we take a look at the big picture over the last year and a half, we had the first rally off the bottom up to 80 cents, pulled back dramatically over a period of 6 to 8 months, and then we've had this move. So it starts to look like a bit of a double bottom, a nice tested low. Probably see some pretty significant resistance at this 80-cent level. And if we look at the consolidation, this pullback we've had over this last 6 to 8 months, and you look at the width of that and measure it up, this 80-cent level is a pretty realistic target to be looking at. So I think once we lose some of this momentum, and it probably happens the early part of next week, maybe look for the dollar to roll back. We'll see what happens on the pullback. If it starts to give back more than, I would say maybe 2.5 cents, that would be indicative that this might have been the best. If it holds up pretty well, who knows where we end up going.
Do you see Polos hiking rates again this year?
Well, if this rate hike doesn't slow the economy, doesn't slow the housing market, and you've got to remember housing is such a big part of the Canadian economy, that if that stays stable, then there's a distinct possibility that we can get an October rate hike, and with that, you might get another little punch as far as the currency is concerned.
What's happening on the U.S. equity markets?
We've got new all-time highs in the Dow, S&P, the transportation index. Now, the utilities have been faltering here in the last month or so since the bonds have settled back down. But with the new highs in the transports and Dow, that's a confirmed bull market as far as the stocks are concerned. You would really need to take out the lows that we put in here in the last 2 weeks to say that there's any sign of a major top of any significance. I've been watching the credit markets. with the long bond rate starting to move up and short rates stabilizing a little bit, the yield curve has started to steepen, but not enough to be of a major concern. And if we look at the credit quality in the spreads, you can see that the high yield JNK or the HYG exchange traded funds, those are moving along steadily on the upside. You need to see those break down similar to the market below the lows of the last 2 weeks to think that there's any really big break coming. We had thought that there might be as much as a 4.5% to 5% correction in late June through July. It looks as though that was much, much milder than we might have thought. And right now, the easiest path seems to be on the upside.
Does that mean we really should keep watch? Are we in conditions that might see another Black Friday in August?
There's always those distinct possibilities sitting out there. You know, we've got to be watching to see, keep an eye on the credit part of the equation, the spreads there between the short and long term, also between high yield and high quality. And then, if the earnings numbers are looking good, but the forward guidance from the various corporations here during this earnings season of the next couple of weeks, if the market does not take those well, that would be a red flag to be aware of. This week, at the end of the week, you started to see the banks coming through in the States. They were beating on the estimates of what they've done in the last calendar quarter, and everybody had low estimates because we had low volatility in the market. So their trading arms were not able to put any decent numbers to the bottom line.
Ross, thank you so much for chatting with us.
Always a pleasure, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Danielle Park, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
I'm Brian Fowler, President of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
The Bank of Canada boosting its trend-setting rate, and I'm hearing panic from mortgage holders in Vancouver and Toronto even over this tiny 0.25% boost, saying it's going to make their house almost unaffordable. Were they smart to buy a house in the first place if they couldn't afford a hike?
That's it in a nutshell, right? If you literally have to depend upon the continuance of emergency lows in interest rates for the rest of your life to be able to afford your shelter, you've bit off more than you can chew. And unfortunately, some 33% of mortgages in Canada today are floating rate. A full 77% of people polled recently said that an increase of $130 a month would be very difficult for them to absorb. So we're talking about a country which has doubled down on debt in a way that we have never seen in the history of our 150 years. This is the most indebted our nation has become on a household and business level, and it is going to cause us the consequences which normally flow from such things, which is to have a very difficult reset period coming where prices must come down to reconnect with affordability and incomes in the country, and where the highly levered have to lose their homes, write off, through bankruptcy and various reorganizations, where the lenders have to lose money that they should not have advanced. It's a very big repricing cycle. It's very economically devastating. But the solution is not to leave interest rates at near zero for, the rest of our human existence. I mean, it's madness. It is madness. Central banks painted us into this corner. They should have raised rates, the Bank of Canada raised last in 2010. It should have continued to raise from there to normalize policy, as should have the rest of the world's central bankers. The global growth story really peaked out in 2010. They started their QEs because they didn't want to have any mean reversion period, so they were successful in inflating asset prices. But that created all this horrendous addiction to debt, and unreasonable increases in asset values, and predominantly we see that in the price of shelter. And that is, of course, a staple of human life, whether it be rents, which have also gone up disproportionately with the inflow of, quote, investor money into that space, where people have been gobbling up housing and multi-unit dwellings as a way to replace income, thanks to the very low interest rates which have plagued us now for the past 9 years. And all of that it's all connected. Everything that has happened, the bailing out of the banks in 2008, the continued injection of trillions and trillions and trillions of dollars of excess capital, which wasn't required by the real economy or demand, but went into these superfluous asset bubbles, which are now hanging over us. And, I feel sorry for people who didn't realize what was going on and who weren't paying attention, but unfortunately, that's the case pretty much every cycle, repeatedly through time. If you're not paying attention, if you're over-levering in the boom time, if you're not building up savings for the down cycle, if you're not lowering your leverage so that you're prepared and have some seed corn to draw on, then you typically get damaged badly in the mean reversion cycle. And unfortunately, at this time, I think we have the most population ever, as I said, that have done this very destructive reaching for, whether it be reaching for yield with overvalued financial assets, trying to replace guaranteed interest, which was lost as rates plunged, whether it be the pensions, which have all cannibalized themselves and going after, more and more aggressive assets to try and make up the deficits, which it's failed and we just keep getting bigger deficits, or whether it's the real estate market and all the families which are now, holding on by their fingernails to assets which they actually can't afford and never should have bought. So it's really set us up for a very difficult period.
I take a look at the size of the homes our parents had. They were tiny compared to the single-family homes now, where they say, people have to be smaller. But my wife pointed out her parents' home, 2 bedrooms and a basement, was 100 square feet smaller than my 2-bedroom condo in Burnaby. Do people really have to look at downsizing and let's go back to affordable rather than what we want?
There's no question. There's no question. I mean, if you think about it, affordability in this country is at, the worst level we've seen in many, many decades for housing, even as interest rates are at the lowest in our lifetime. So that really tells you that what's wrong here is the price, right? Because we can't have rates any lower, and yet affordability is, horrendous for the average worker, the average family. The average new home sale in Canada in May was at $522,000. Just as a point of comparison to the U.S., that same stat for the American market is in the 350 range, 345.8. So new home sales in the U.S. have been climbing steadily, and in fact are getting back. Prices are getting back to where they peaked in the 2006-7 cycle in the U.S. in many cities. But in Canada, that just gives you a sense. We are 522. Like it's off the chart, and that's, of course, in many cities, people are spending upwards of 70% of their income just to try and keep that roof over their head. That is not sustainable. It never has been. People have to have funds for other parts of their life besides just shelter. So here's what I project is going to happen in this mean reversion period coming, which is where, as I say, asset prices have to come back down. As people can't take on more debt. Even without raising rates, people can't take on more debt. They can't afford more payments, even at zero rates here. So that's how you know that you must be at the end of this crazy period. And so what happens is that those who have overextended, which are many this time, realize that they must start liquidating or trying to sell and downsize. And that urge to downsize really hits a lot of people all at the same time for all the same reasons of overextension. Meanwhile, while they've been paying that much for housing, they have not been saving. They have not been topping up retirement accounts, Same with this craze of low rates and incentives which has driven people to buy all these new cars in the past few years. It would have been better for them if they'd have taken the bus or, bought a cheaper used vehicle. But no, because of the incentives in the system, it has made everyone reach for, a $40,000 and $50,000 vehicle, which just means they'll be paying it off for 6, 7, 8, 9 years. Which means they will have less cash flow over the next many years, which means they still won't get to saving. So really, it has really cost us a great deal in terms of lost wealth that will, over the next decade, by this heinous misallocation of capital and reckless, putting things into non-productive pursuits. So we really, it's a dark chapter, but I think that the good news is the penny's starting to drop, and people are starting to realize, we see that in stats even in the GTA area near where I live, people walking away from deals, people leaving $40,000 deposits on the table because they realize they've overextended and the market has turned in the past few months. So I think that, there's a moment of sobriety finally that hits, and many people are going to these, bankruptcy reorganization, trustees in bankruptcy, working through creditor offerings, getting pennies on the dollar as a reorganization of their finances, and just basically walking away. So that trend of walking away, I think, is just getting started in Canada, and we're going to see a great deal more of that.
Are the bankers the authors of their own misfortune, not really being honest with people about the real cost of buying that house?
No, there's no question that the current incentives in our financial system have been for people to reach for more risk. And the sales culture that has taken over our banking system over the last 30 years has really been compulsively focused on increasing sales. And in this case, that means sales of risk, of debt, of, high-risk financial products. And so what we've praised our banks for being these, extremely profitable entities, just as the U.S. banks were into the 2006-07 peak in crisis. They were the most profitable companies in that country. They contributed at 1.40% of the earnings in the S&P 500. That's what we've seen in Canada the past few years. As the oil companies, the price of oil peaked last in 2015, has turned lower since. We have, much less profitability in the energy sector. We have, a lot of debt there building up, which, by the way, is coming up for renewal again starting in 2018. But the engines that have really grabbed and taken the Canadian economy forward, even at a slow pace over the past couple of years, have been the financial sector and its, reciprocating asset, which is real estate. And so the Canadian banks have continued to power ahead with great profitability in this environment, but it reminds me very much of the similar trends we've seen in the United States, as I say, in this past cycle, of the trends we saw in the banking system in the 1920s, which culminated in the 1929 crash, financial devastation, and debt depression thereafter. Over leverage is a classic, epic, catalyst for all the negative problems and deflation and lack of demand that follows after that. And so we've seen this play out many times. There has not been one single financial bubble in human history which has not imploded. And when it does, it mean reverts back below where it was, where the average, way below average, in order to restore that sort of long-term equilibrium. So we should expect, I've been putting charts on the blog recently, on my blog, Juggling Dynamite, just showing the remarkable overshoot that we have both in Canadian debt levels as well as in the price of our realty, even relative to the U.S. cycle, which, don't forget, was, prolific and led the world economy into a major recession in 2008 when the property bubble there burst. We have, extreme overvaluations in Canada, much greater than they had there, and you can see that in some of the charts that I've put on. So when people are, bemoaning the fact that the Bank of Canada is raising rates and that that's somehow the central bank's fault, that they're causing weakness, or that the government's new regulations where they're insisting on stress testing, new buyers, even people with down payments at rates that are 2% higher than current and all that. That's actually all what they should be doing. It's what they should have been doing all along. The criticism I have for the central banks is that they have let this disaster build to such a fevered pitch for the past many years. They haven't raised rates in 7 years, the Bank of Canada. That was a big error. They should have been doing it over the last 4. But the same goes for the Bank of England and the Bank of, the Bank of Japan and the ECB and the Central Bank of the U.S. These people have been extremely misguided and devastating. Now, I believe we're coming into a period where, as they say, the pitchforks will be coming for central banks. Once these bubbles burst, once the revelation is that net worth that people thought they'd accumulated was actually a mirage, that, the asset values plunge, but the debts remain, so the balance sheet is decimated. Once people realize that this has not been a fix, but it's been a magnification of the problems we saw in 2008, then I think you're going to have a public revulsion against the central bank's elites and these theories of add, debt, and stir, finally, which will be important. But unfortunately, disparaging them or throwing them out of the seat or, none of that is going to restore financial viability. None of that is going to bring back the money that's been wasted. None of that is going to pay the deficits that are everywhere in all the pensions and institutions that we rely on as a civil society. Unfortunately, all of us, the taxpayers, are going to be paying for these mistakes for many years from now.
We'll have more with Danielle Park next on This Week in Money.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. Danielle, with expected stress to the Canadian economy likely, what should people be doing right now to make sure that they're not caught out by some sudden plunge in housing prices and the stock market?
Well, nearly a third of Canadians surveyed recently said that they're already feeling that they're in over their head in terms of their mortgage payments, never mind all their other payments and upkeep of their property, but just trying to keep up with their mortgage payments. So that suggests to me that many people, as I say, have bitten off more than they can chew. The best thing to do here is to not stick your head in the sand, not, hope for, the impossible, and hope that 1 + 2 will equal 7. It's just not a rational plan. What you should do is really decide how you can lower your cost structure. In many cases, you're going to need to go get a professional consultation with a trustee in bankruptcy, so that you can do a reorganization. In many cases, your income is just never going to be sufficient to pay off the amount of principal that you've taken on thanks to these debt bubbles. So it requires just, proactive steps. The longer you pretend and ignore and keep sticking stuff on credit cards and lines of credit, the more depths you're going to get into in terms of this hole. So it just means, if you're over levered right now in real estate, many people have borrowed against their existing homes, Jim, to buy, quote, investment properties. That's likely to be a very devastating outcome if you haven't got the liquidity and the income to service that and continue it, through the next many years. So if you ask yourself, if the price of the real estate that I'm currently holding was to drop by 20%, how would that impact me? If the answer is no problem, no big deal, I just keep renting it, or my income is enough, and that sort of thing. Now, also, stress test yourself. What if something was to happen to my income flow? What if I was to lose my job, or I was to lose a significant portion of my revenue if I'm a business owner? What is your plan? Because unfortunately, these things are positively correlated in the economy. So, in other words, once asset prices begin to retrace, whether it be housing, and the stock market typically goes at the same time now because we have this highly financialized world markets and economy. So you're more likely to see a downturn in asset prices at the same time that you see a plunge in income, revenue. You'll see a spike in unemployment. So those things make it very challenging for people that are highly levered, that don't have a lot of liquid savings, to make their way through the period, to kind of just bide time until the correction process happens, and then you get into the next growth phase thereafter. It's trying to get through that correction period that you have to worry about. So if you find that your answer to when you look at those stress testing, as I say, with those kind of scenarios, if you can't see how you would make your way through it, if you can't afford to maintain and hold on to the things you have, then be proactive now in trying to downsize it. Don't think that buying things at horrible prices means that you're investing. It means that you're speculating. And speculators almost always go bust, Jim. It sounds great, it may work for a year or two or look like it's wonderful, but then it typically implodes and the people lose their shirt. So I'm just warning people to be wide-eyed, be very practical, realize that what we've been through has been a prolific bubble period that cannot continue because no bubbles ever have. So make sure you have a plan for how you will survive and how you will downsize now before everyone else is trying to do it at the same time. When everyone's trying to do it, you've waited too long and you're in a everyone's trying to dump things phase, and that's very devastating when you're trying to be a seller in that environment. So it's better to do it ahead of the pack, raise your cash, lower your debt. Don't think financial markets are going to provide diversity in this environment for your savings. Typically, equities, corporate debt, all of it trades in the same cycle, so it will all have to mean revert about the same time. The only things that you can really have a store of value in are things like cash and, some high-grade government bonds at certain durations, and a house paid for, awesome. If you can afford to maintain your house, if you've got savings built up, great. But no money that you need in an emergency fund sense. If you were to, have a lack of income for a year, for example, or a big decline in your income, no funds that you have set aside for that emergency should be anywhere near asset bubbles. So it shouldn't be, in other properties or in the stock market or in corporate debt. That's a bad plan.
What about people who have taken out home reversal loans or chips?
Yeah, so basically, it's the same thing as, same type of idea as lines of credit. Typically, these are very devastating products. They're great for the people selling them. They're great for commission providing to the product producers and marketers. But in terms of a product for an individual, you're paying the price of not wanting to face your financial facts, of wanting to have your cake and eat it too. So basically a reverse mortgage, as I've commented many times in the past, for someone in the odd scenario where they perhaps have a significant illness and they don't expect to be able to live for a very long period of time, there may be a case where staying in your own home, just till the end or something makes sense. And so you would, if you have no other means of liquidity or paying, perhaps that would make sense. But generally speaking, you'd be far better off to sell your asset and get your finances to a scenario where your income affords your expenses, where you have cash flow or savings to cover your costs, not eating your equity alive, literally, during your lifetime to try and maintain the appearance of something which you actually can't afford. And the same goes with these, lines of credit or HELCOs, which have been heavily sold by the banks as this, quote, emergency fund. People are told, oh, you don't need savings because you have an asset with a line of credit against it. If you get into any trouble, you can just draw on the line of credit. Well, first of all, it requires an incredible amount of financial discipline not to keep rolling other debts onto that line of credit, and we've seen that repeatedly. That's the pattern. People will pay it down, and then something comes up, and they throw on a new car, or they throw on an expenditure, a trip, or whatever, that seems good at the time, and you just keep rolling it into your debt. So you're always cannibalizing your savings that way, your equity, your funds that could provide you with savings in the future are being cannibalized, and compound cannibalization through interest costs. So it's really not a good idea. Very few people can manage that properly. It's kind of like, if you don't want to get hooked on crack, don't start taking crack, right? This is the thing with open lines of credit. They're too tempting, they're too dangerous, and you're better off to just get rid of your debt as fast as possible, and don't be seduced by all this talk of, well, interest payments are tax deductible on investment loans and all this nonsense. You're far better off just get out of debt, build up your savings monthly if you have extra cash flow rather than paying debts.
With baby boomers now outnumbering young people in Canada, would higher interest rates actually be a help for them if they have money in the bank and actually maybe be able to have a sustainable income from that?
Well, absolutely. I mean, higher interest rates are essential to incent the right kind of behavior in the society, to move from a speculation focus, which is where we've been certainly for at least the last decade, to move away from that to a frugal, saving, spend less and save more mentality, which is actually how you build financial strength. Always has been how you build financial strength. So we just need to, of course, higher interest rates are important. All this talk about compound returns, compound gains, you cannot have compound gains on savings when you're holding assets that can lose big chunks of their value. You only can get compound growth when you have steady income coming in that rolls over into and earns income on that income. That's the only way you can actually get compound savings growth over time. And of course, we need some higher interest rates in order for the math to start working again on, things like I say, like pensions and savings plans for retirement and education and all these things. But unfortunately, we're going to have to give to get, right? In order to get that sustainable system back with a healthy, math-based rate structure, you're going to have to give up the other side, which is these overinflated asset prices, which came because of these artificially low rates. So once you start to move back towards natural and productive rates of interest that incent savings and investment in the economy rather than speculation, once you start doing that, you're also going to have a mean reversion in things like stocks and corporate debt and preferred shares and all the things, REITs, all the things that have been insanely overvalued as rates were pushed to negligible levels will have to give back price, and they too will begin to earn higher yields, but first the price has to come down significantly.
they keep bragging on some of these television ads about 7% returns on their investments in real estate. Are they setting people up for a big fall if they get into that?
Well, I'd have to look at the individual scenario, but if people are talking about, a net yield on real estate of 7%, perhaps they're talking about, based on carrying costs, rents less carrying costs, and there's a yield to be had there. In some cases, maybe that might be a reasonable thing for a portion of your money, but it would depend very heavily on the math of the scenario, the fund itself. Again, look at your stress test scenario. If that manager or fund was to have, a large drop in the value of its assets, how much leverage has it got? How much debt has it taken on as a counter to these to the assets in the fund? What's their rental rates? How much of their portfolio is commercial yields? Because commercial properties are still massively oversupplied in North America and certainly in Canada. And in places like Calgary, they've got huge supplies still being built and being brought online, which is going to further depress rents because, they've just overbuilt. This credit bubble has infected everything and over-allocated resources for more than a decade so that now we have such excess supply that will necessarily push down the rates of rent that can be collected. So all those things matter. I'm not saying that, that real estate can't be a good investment. A lot of things can be a good investment, but it always has to go back to math and, stress-proof scenarios, and will it be still a good investment at this price and that price, and what are the risks, and leverage. All these things have to be accounted for, and unfortunately, very few people actually do the work of that. Mostly they're attracted by salespeople who show them glossy brochures and pie charts and tell them they don't have to worry, and they just sign up with charisma instead of with thought and sober reflection.
Danielle, thank you so much for being back on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's also the president of Venable Park Investment Council, Incorporated. Her website is jugglingdynamite.com. Coming up next, gold and silver activist Ed Steer, next on This Week in Money.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ed Steer. He's the founder of edsteergoldandsilver.com and a director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Edmonton. Ed, welcome back to This Week in Money.
Oh, glad to be on your show again.
Ed, on July 7th, over 5,000 silver contracts were sold in just 1 minute, causing a flash crash. What are you hearing about it?
Well, I think the flash crash was what caused the selling. This is just proves beyond a doubt that the COMEX price mechanism is broken beyond repair, especially in the silver. This was high-frequency traders gone absolutely run amok with their spoofing, and what they did is they ran the stops at lightning speed, and of course anybody who had a long position on got blown out of it instantaneously, and it was well over 5,000 contracts that were traded during that spike down. I think it was, 9 o'clock in the morning over Shanghai time, 9 o'clock in New York, so it was an ugly event, but it was just was brutal. I was, I'm going to quote what Ted Butler said about this in his Saturday column, and he's an authority on this, so let me just read what he had to say. Late reports indicate the CME has busted all COMEX silver trades on Thursday evening below 1540 spot, even though the printed low was 1434. And there's quite a difference between 1434 and 1540. Essentially making all trades below that level non-existent as if they never occurred. The problem is that the trades below 1540 did occur and were openly witnessed, and the CME's end run around admitting that COMEX is a crooked exchange only proves that those who run and regulate it are sniveling cowards for not openly admitting the obvious. So, this was an event that the computers just run amok, and the CME and the COMEX won't do anything about it. They just let the big boys, that's the bullion banks and the managed money traders, play their games, and it resulted in that big flash crash we saw last week.
Is this the same thing that happened to silver when they had problems with the London exchange?
That would be a different issue entirely. I'm not very familiar with the London exchange, but regardless of that, the entire price-fixing mechanism for silver, gold, platinum, and palladium, all the precious metals, is so crooked and has been crooked for actually generations now, that unless it's fixed one of these days, we're going to continue having incidences like this, and there's no way to avoid it, whether it be in London, New York, or Chicago, or wherever these metals are traded. As long as they're dealing with a crooked exchange and a crooked market, we're always going to have problems like this regardless of where they occur.
Is there anything we can do about it?
Sure. Have legalized reasonable position limits on all commodities, especially the precious metals. And if that was enforced like it should be, then the problem would exist tomorrow, and we'd see a true free market price for all four precious metals. And I can tell you right now, they would be monstrously higher than they are today.
The world's second largest silver mine is shut down in Guatemala. How is this likely to affect the price of silver?
Well, that's ancient history now. I mean, normally in a market where one of the three largest producers, the third largest, second largest silver producer in the world, had to cease operations, would make a huge difference in the price, because if the market was operating freely, it would operate on the principles of supply and demand. And we already know, and most of your listeners already know that, and you know that, and I know that this is not a free market. And the COMEX and NYMEX CME group is a rigged game. So they could shut down all the silver miners in the world at once if they wanted to, but as long as there's somebody there to sell them, prepared to sell the metal short, then the price will do whatever the paper market tells them to do.
How are the commitment of traders looking for gold and silver?
As I said in my column this morning, there'll be certainly one for the record books. There's no question about that. It's just a matter of how much more wildly bullish it's going to get, particularly in silver. It's off the charts bullish. All we're doing is waiting for a trigger event for the next rally, and then hoping that J.P. Morgan and the other large bullion banks don't go short it, because if they don't, then we're away to the races.
Do gold and silver miners usually lead the bullion in bull market runs?
Well, I'll tell you what, we're certainly seeing a lot of bottom fishing, especially starting last week, and especially after that flash crash on, was it Thursday morning or Friday morning, whatever. There was a lot of trading in the precious metals, and we've seen prices move sharply off of the bottom. So they certainly lead it to a certain extent, but what they have a tendency to do, if they don't lead it, they have a tendency, once the rally gets going, is to vastly outperform the underlying metal itself. And I expect this bull run, which I expect to start imminently, will be exactly the same, where the shares will lead the metal itself.
Are rising interest rates good for gold and silver like they were in the late 70s?
To tell you the truth, the interest rates at these low levels, whether they're 1%, 0.5%, 1.25%, or 1.5%, mean absolutely nothing. All that matters is the paper trading that's going on in the COMEX. The banks of the world and governments of the world cannot afford to have interest rates up around 4 or 5%. So I can pretty much guarantee you that I won't live to see interest rates like that again. And as far as I'm concerned, interest rates will have no bearing at all on the price of gold and silver and other commodities going forward.
Are gold and silver in sync this year with their long-term seasonalities?
Well, One of the things about seasonality is the fact that, and I hate going back to this all the time, is the seasonality is caused by the trading on the COMEX. It's a paper market. So when you look at the seasonality, quote unquote, you're looking at the way the paper market trades, and nobody knows what the true free market price of any of the precious metals are, or how they would actually trade in a free market that was based solely on supply and demand. So when I first started off in this about 17, 18 years ago, I was always a slave to this seasonal demand thing until I discovered and fully understood how the markets were controlled by the paper game. And of course, the paper traders can set any seasonal price pattern they wish. So in a truly free market, there may not be any seasonal pattern whatsoever. So when you say seasonal pattern, I take it with a really big grain of salt.
Maybe it depends on when the big bankers go on holiday.
Yeah, well, it's exactly right. I mean, when it's summertime and they head off to the Hamptons or wherever the heck they have their holiday homes, they take the time off from trading, and they don't let the trading start until they get back to their desks on September the 1st after the Labor Day long weekend. And that's, if you look at the trading pattern and the seasonality, quote-unquote, factor, then that pretty much sums it up.
Is the U.S. dollar under pressure, and is that good for gold and silver?
Well, the U.S. dollar is so hugely overvalued. It's like precious metals themselves. I call them the gentle hands. If the gentle hands weren't there propping up the U.S. dollar index every day, it would have crashed and burned 5, 6, 7, 8, 9 years ago. And as I keep saying in my column, and I've been saying it now for 10 years, if the powers that be weren't propping everything up that wanted to crash and burn, and weren't suppressing the prices of everything that wanted to blow to the outer edges of the known universe, the world's financial, economic, and monetary system would be a smoldering ruin within 5 business days. And as far as I'm concerned, the dollar is one of these currencies which is, like every other paper currency in the world, headed for the dustbin of history, and only the paper traders in New York are keeping it alive.
Would that be a good thing or not, to let things settle out and find out what their true value is?
Well, I'll tell you what, isn't that an interesting question? The markets are so distorted now. Starting, I would think back, going back to Bretton Woods when gold was fixed at $35 an ounce, and then again when it was let run wild in 1981. Letting the free markets run wild would certainly ruin the governments and the banking system, and it would probably throw a real monkey wrench into the world economy and economic system for several years. But the longer they continue to suppress prices of everything, whether it be commodities, and keep things artificially high or artificially low, depending on what they are, the sicker the world becomes from an economic and monetary system. And as you know, the world's debt is so large now, I think it's over $200 trillion, that it is never, under any circumstances, going to be repaid. And the only two ways they can get rid of it is A, default on it, or inflate it away. And I think, knowing the banks the way I do, they're probably going to inflate it away. But the whole system is sick to the core, and this Frankenstein economy that we're looking at right now deserves to die regardless of the price that has to be paid by everybody in the process.
Is the Canadian dollar likely to move higher with gold and silver?
Well, I'll tell you what, anybody that digs commodities out of the ground, mostly for a living, including Canada, which, like Australians and Africa and Central and South America and Russia, and most economies actually that are hewers of wood and drawers of water, they will all benefit, their currencies will all benefit from rising commodity prices. And this is one of the things that the financial system, the paper hangers on Wall Street and the banking system worldwide have done over the last couple of generations, as they've suppressed commodity prices to benefit the paper hangers. And once we revert back to what it was before, well, then I think the Canadian dollar will certainly strengthen. And one of the reasons is that precious metals and all other commodities are going to rise too.
Do you have price targets for gold and silver for this year and beyond?
Very large numbers. If you're asking for a number in gold, wow, very large 4-digit price. In silver, I expect to see a 3-digit silver price of some magnitude. And that only will happen when the boys at the CME Group and the COMEX take their foot, and J.P. Morgan, especially J.P. Morgan, they're the ringleader in the price management scheme. And Ted Butler has been following their work for what their goings on for the last 25 or 30 years. He's the real authority on this, and once they decide that they're not going to go short the next rally in the precious metals, well, we're going to see rallies that will go down in history.
Is gold the choice of institutions and silver the choice of investors?
Well, I think the only reason that silver is not a choice of the institutional investor is such a small market. It is a tiny market. Some of the institutions have bought silver, small quantities of it, but when you've got billions and billions to spend, investing $1 billion in silver would move the market in a major way. So what the big institutional investors do is they just buy gold through GLD, or some of them do buy physical. But gold is where it's at. However, I expect that to change once silver price really starts to take off. Then you'll see the institutional investors get into silver in a big way, and of course that'll just be more fuel to the silver rocket fire, and it's something that Ted Butler and the rest of the silver investors out there have been waiting for decades now.
Ed, what's new with the Gold Antitrust Action Committee?
Well, we, as Winston Churchill said, we just keep buggering on. I know that Chris and Bill certainly are out there speaking at conferences. I'm out speaking at conferences myself. The word is certainly out there. Bill and Chris started this thing off in 1999. And, of course, Ted Butler's been on this thing for more than 30 years now, preaching the gospel that the prices are rigged. Everybody that's anybody in the precious metals world, unless their jobs depend on them not seeing it, pretty much know what's going on right now, including all the miners out there. So it's been a constant struggle. The miners just don't seem to be interested. Not all. There's some obvious exceptions to that rule, and the first one that comes to mind is Keith Neumeyer over at First Majestic Silver. But most of the miners, they watch politely but refuse to do anything about it. But there's no question in anybody's mind out there that everybody knows the game is rigged.
Ed, how can people find out more about your newsletter?
They can just Google my name, Ed Steer. Last name is spelled S-T-E-E-R, Ed Steer, and my daily newsletter website will come up, edsteergoldandsilver.com. And they could read the sample column that's there and decide whether they are interested or not.
Ed, thanks for being on This Week in Money.
Entirely my pleasure. Thank you for having me.
My guest has been Ed Steer, founder of edsteergoldandsilver.com. He's also a director of the Gold Antitrust Action Committee. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Danielle Park, and Ed Steer. And thank you for listening. Stand by for company showcase updates with American Manganese CEO Larry Reaugh and Aben Resources President Jim Pettit. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. We're speaking with Larry Reaugh, President and CEO of American Manganese Incorporated. Larry, welcome back to the show, and what kind of an update do you have for us this time?
Well, Jim, I'm glad to be back on the show, and just before I update everybody, I'd like to mention that two of my best NDAs have come from broadcasts that were made on YouTube from these podcasts that I'm doing. So, we're connecting with people that, that listen to what's going on rather than reading what's going on. So this is a great thing. And but the update is, last time I talked, I mentioned that we'd be putting a timeline out on what we were going to do with our next schedule of events in the research department.
And we did put that out in a press release yesterday, and of course it went down. It was a good press release. It went down as usual. But it bounced back today from 13.5 to 16, so I'm happy about that. Now, the reason for putting this out is to let people know that we're on time and on budget. And that's important because there's people been going on sites and saying that we're a bankrupt company, and we're not. And we certainly have more than ample money to see ourselves through the filing of our patent and, preparing for the next stage. So what it does, in addition to that, it lets people know that are, that have got NDAs with us where we're sitting in the queue. And we're not that far away from being in completion. November is just around the corner. So it's informative. It gives the shareholders a bit of a path that they can follow to see how the progress is going and when they may or may not expect a press release. And so it answers a lot of questions that I've answered individually on emails for the past few months and frees me up to actually try to progress the company's business plan, which will probably be something in the next release or two that I'll be talking about. I've never really talked about what is our business plan, but I think it's time to bring that out. And you don't like to talk about things that you found out that competition may not have. And so, that's why the delay in putting out the timeline and the delay in putting out the BP. So anyway, this is strictly for shareholders and new shareholders to get updated and keep updated on the company. And I can't say that I'm not happy with everything that's going on, for sure. I'm extremely happy. We've had no major setbacks. Our proof of concept has been proven. And, there's not much more you can say about that except that we were very successful. And as a matter of fact, I had another conversation with another group that are interested in what we're doing. And they were very optimistic about how things were going forward. So, it's only a matter of time till we attract a major partner. And that's all I can say to that, Jim, is that's out of my hands. It's up to the people that are talking to us, and so you can't push on that too hard. But let's hope there's a lot of disappointed people when something does happen. So that's what's been happening here. We're certainly happy with all the hard work that's been done, and happy with what Chemetco has done. Chemetco has proven again to us that they are a superior research firm in Canada. They've probably won't be more than a few years before they'll be the largest research firm in Canada. And I was down touring their plant yesterday looking at some of the bench scale work that was being done, and I see other work in progress down there, and they've got some major contracts underway. So, I'm happy for them, and I'm happy to have their scientists on site, specifically the CEO himself, whose idea was that maybe we should recycle batteries, and he's as excited as we are seeing the progress on this show. But that's really what I wanted to say was that a lot of shareholders have been asking for a timeline. I think I published the first timeline on what was happening with companies back in the ADNAC days, and by the way, we met all of those milestones in that timeline, and we were probably the first company to actually have permits within 3.5 years from drilling. And those are permits to construct and the environmental permits. So, timelines are good, but timelines can also work against you. If you miss a date, you're under fire for a while. But then that's natural. So the timeline's out there. It's posted on the site, and that's about all I got to say about it. It's all addressed in the press release.
Larry, for new listeners, can you maybe again give us a thumbnail sketch of American Manganese and what it does?
American Manganese is a company that has a patent-pending process for recycling lithium-ion batteries. We've taken it from proof of concept to proof of operation, and on a bench scale, and we get 100% of the cathode materials back, which is the most expensive part of the battery. And that was taken off of a patent that we had spent millions on for treating low-grade ores in the United States and being able to produce electrolytic metals at about equivalent cost to what it costs in China. So that's saying something. And you can reach us at AmericanManganeseInc.com. That's our website. You can reach me at 778-574-4444. And you can email me at lreaugh at R-E-A, that's L-R-E-A-U-G-H at AMY.com, AMYMN.com. And we trade under our major trading area is the Vancouver Venture Exchange under ticker symbol AMY. We also trade in the U.S. under ticker symbol AMYZF. And under the symbol 2AM on the Frankfurt Exchange.
Larry, thank you so much for the update.
You're welcome.
I'm Jim Goddard. My guest has been Larry Reaugh, CEO and President of American Manganese. We were speaking on July 14th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
My guest is Jim Pettit, CEO and President of Aben Resources. Jim, welcome back to Company Showcase.
Thank you very much.
Jim, I understand you have a big company update for us.
Well, we are coming up on a drilling season, and it's been long awaited, but we're getting ready to go for August 1st.
And what does that mean for the company?
Well, we've had crews in the field since the beginning of, for a month anyway, and they've been identifying the areas that we want to drill in. So pad selection, site selection for the drill pads are about to start. That'll be starting next week, and everything will be mobilized and ready to go by the 1st. We're going to be starting out this season with about 2,200 square meters of drilling. Could have up to 8 or 9 holes. It's a good start. We're going to initially start up in the north part of the property called the Carcass Zone, which had some really tremendous high-grade results several years ago. And we want to go back in and confirm them and try to connect the dots there because the two holes are about 70 meters apart. We're going to go in and retest. I mean, they had some what I would consider spectacular grades, like 9.87 grams over 29 meters, and the other one was just about 5 grams over 13 meters, and we're going to go back in and retest that and try to extend that to the south. That looks like a pretty strong possibility. And then we want to get down to the boundary zone to the south of that. That had the highest grade that was discovered on what is now the Forrest Kerr property, now that we've combined 3 other properties into one. And those grades ran about 11 meters of 33 grams. So we'll be poking a few holes in that area. That didn't have a lot of work around. As a matter of fact, it looked to us, now that we've had a chance to really study it, that they were drilling
in the direction of the system rather than drilling across it. And I think we have a better chance now with the understanding we've got, and we want to definitely go test that high-grade feature. And then after that, we've got another zone on the Forrest towards the middle of the property, the Forrest Kerr property. And it's a bit of a blind target, but it's going to be, if it's what we think it is, because there's a significant outcrop, multiple shear zone hosting quite an abundance of copper oxides and sulfides. So we'd like to get under that and test it. Because in the region there is significant copper and gold showings on surface. So that's where we're going to go. That'll be starting on the 1st of August. Well, all things being equal. We're going to be mobilizing hopefully from the Glore Creek Road rather than the southern, the Alta Gas Camp itself, which can save us a substantial amount of flying time. And we're just waiting to hear back from Glore Creek, those people right now.
Jim, where's all this action taking place?
No, good question. This is up in the Golden Triangle, northwestern British Columbia. Pretty much exactly halfway between Snip, where Skeena is drilling, and SK Creek, where now SK Mining is drilling. We're right in the middle. And there'll also be other companies up there drilling. Colorado's just starting up. I know Garibaldi, I believe, is starting up. And there'll be lots more this summer.
Jim, for new listeners, can you tell us a bit more about Aben Resources?
Well, Aben's symbol is ABN.V. It's also listed on the pink sheet down in the States, ABN AF. Frankfurt is E2L2. We've just closed the financing. I'm just actually waiting for the final numbers, but we'll be about 45 million shares outstanding. And I'm just waiting on the diluted shares because we've got some options that have expired. So there'll be new numbers there, but it should be about 58 million. Stock's trading at 10 cents. It's cleaning itself out quite nicely right now. It's been trading some reasonably good volume lately. The chairman of the board is Ron Nedolinsky, who's got a wealth of knowledge in this area. He discovered SNP and was involved in SK Creek. Tim Termundi is also on the board. He started his career with Ron up in that area. We've also got, Cornell McDonnell is running the program. He's got a lot of experience there in central BC, just around the Smithers area. And then as far as advisors, Henry Omack and Mike Roberts have got a tremendous amount of background in that area. And then you can find us at abenresources.com and info@abenresources.com. And if you ever want to contact the office, you can contact myself or Don Myers at 604-687-3376.
Jim, thanks for the update.
Good. That's good.
My guest has been Jim Pettit, CEO and President of Aben Resources. I'm your host, Jim Goddard. We were speaking on July 13th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.